Silver isn't priced in ounces anymore. On paper, the world spot price says you're looking at a clean global number, but in the real world, the price you actually pay to get metal in your hands is drifting into a different orbit. That's the paradox. The market claims price discovery, yet dealers are living in what many now call a two-tier reality. And if you're using spot as a compass, whether you stack, invest, or just want a hedge, this matters to you because the number you trust can stop matching the thing you're trying to buy. Here's the detail that should make you sit up. Nearly 400 paper ounces are traded for every single physical ounce produced. That's not a small mismatch. That's a different game entirely. But here's the part nobody is saying out loud. If spot is a convoluted, manipulated futures contract, then what happens when physical holders simply refuse to sell at that number? Because once that starts, the screen price becomes a suggestion and the real price becomes a standoff. What we know so far is only part of the picture. The visible event is simple. The paper price of silver and the physical price are no longer moving together. But that framing is too small. This isn't a one-off dislocation or a temporary squeeze. It fits a larger pattern that's been quietly building inside the market structure itself. For decades, silver pricing relied on futures markets to signal value. That worked as long as physical delivery was rare and trust held. But now market participants themselves are signaling that this mechanism has stopped doing its job. Dealers are not reacting to headlines, they're reacting to inventory that doesn't exist and customers who won't sell. When wholesalers ignore the paper price to maintain operational viability, that's not speculation. That's behavior. And notice the asymmetry. The paper market can expand instantly. Contracts can multiply with leverage. But physical silver doesn't scale. It has to be mined, refined, and delivered. When those two systems diverge, the paper side keeps talking to itself while the physical side goes silent. So here's the reframing question. If the price is still moving, but fewer and fewer people are willing to transact at it, is the market discovering value or just recording activity? Because that distinction changes everything about what comes next. The claim sounds extreme, but the evidence is already visible. The silver market is no longer clearing through price. It's clearing through refusal. Here's the concrete detail that proves it. The spot price is built on futures contracts where roughly 400 paper ounces trade for every one physical ounce produced. That ratio isn't an estimate, it's the operating reality of the market. For years it didn't matter because most contracts never asked for delivery. But now delivery is exactly what's being stressed. Dealers are reporting that physical silver simply isn't available at the quoted price. Sovereign coins like American Silver Eagles remain constrained. Premiums stay elevated even when spot pulls back. That shouldn't happen in a healthy market. Prices are supposed to balance demand. Instead, we're seeing the opposite. Demand stays, supply disappears, and price fails to adjust. Notice what's missing here. There's no surge of new mine supply responding to higher prices. There's no flood of selling from existing holders. The mechanism that's supposed to bring metal back into circulation isn't working. And that's the key insight. When price stops pulling supply back into the market, it's no longer a price signal. It's just a reference point. Now watch how fast this escalates. Once price stops clearing the market, pressure doesn't release, it migrates. The next escalation shows up not in charts but in infrastructure. Normally when demand rises, the system adapts, scrap flows back, refineries ramp up, bottlenecks ease. That's how commodities self-correct. But this time, something different is happening. Instead of expanding, the system is narrowing. Refineries that historically processed everything from 0.999 bullion to 90% alloyed silver are now refusing entire categories of metal. Only pure silver gets through. Everything else backs up. That's not optimization, that's triage. This has happened before in other markets, and it never ends quietly. When oil refineries shut down capacity, fuel shortages follow. When semiconductor fabs prioritize defense contracts, consumer supply collapses. The pattern is always the same. Something that used to be normal becomes unavailable, and people slowly accept it as the new baseline. That's what's happening here. A functioning recycling loop, one that kept silver liquid for decades, is being treated as optional. And once that mindset sets in, scarcity stops being a temporary condition and starts becoming policy by default. Here's why that detail changes everything. If silver can't flow backward through the system, then every ounce that leaves circulation tightens the market permanently. And that sets up the next break. The second proof is more unsettling, because it reveals a contradiction between what the market says and what the system is actually doing. On the surface, silver is treated like a commodity, something flexible, something that responds to price. But behind the scenes, refineries are making a very specific choice. They are prioritizing 0.999 fine silver because it can be immediately turned into COMEX deliverable bars or industrial feedstock. Alloyed silver, 90% coins, sterling mixed scrap is being rejected. That decision isn't ideological, it's chemical. Refining alloyed silver requires nitric acid to separate the copper. And right now, nitric acid is scarce. Here's the concrete detail that matters. Nitric acid is being consumed at scale by the defense industry. The same chemical used to refine civilian silver is also required to produce missiles and advanced munitions. And those systems demand extremely high purity silver for guidance and electrical reliability. So while the paper market implies abundance, the physical system is rationing inputs. Civilian refining slows down. Military production accelerates. Words say one thing, actions say another. This is where perception permanently changes. Silver isn't just being priced as money or metal, it's being treated as a strategic resource. And once that happens, normal market logic no longer applies. Once silver becomes strategic, the system starts moving faster than anyone can control. Here's the mini-crisis stack. First, refineries refuse alloyed silver because they can't get the chemicals. Second, wholesalers realize they're stuck with inventory they may not be able to exit. Third, they react preemptively by capping their buy prices. Even as spot moves up, bids don't follow. This isn't confidence. It's defensive positioning. Wholesalers are openly anticipating a sharp move in the paper market, a big short, a sudden suppression, a violent reset. They don't want to be holding high-cost metal when the screen price drops. So they freeze, they slow buying, they refuse to chase. And notice how fast control slips. Retail dealers can't sell back easily. Individuals see wide spreads. Liquidity evaporates not because demand disappears, but because nobody wants to be the last one holding risk. This is how markets seize up, not with crashes first, but with hesitation, with everyone waiting for someone else to move. What happens if this continues? At this point, the story stops being abstract and starts touching daily life. Because when liquidity breaks, it doesn't hit charts first. It hits people. If you're an ordinary buyer trying to protect savings, you're suddenly paying far more to get in and facing uncertainty about how or if you can get back out. If you're a small dealer, you're squeezed between rising replacement costs and capped buy prices. And if you're just watching from the sidelines, the signal you rely on is quietly lying to you. This is where the trust issue shows up. People aren't buying silver because they expect a quick flip. They're buying because access to their own money feels fragile. Banks introduce friction. Cash withdrawals require appointments. Accounts get frozen without warning. Those experiences push people toward assets that don't depend on permission. And notice how non-ideological this is. It's not about politics. It's about control, about whether you can access what's yours when you need it. If this feels familiar, say so in the comments. Because once enough people reach that conclusion at the same time, behavior changes permanently. And that leads to the deeper mechanism behind all of this. What allows this to happen isn't panic, it's incentives. The system rewards spectacle over stability. Futures markets are designed for speed, leverage, and volume, not for making sure metal changes hands. Banks earn fees. Traders profit from volatility. As long as confidence holds, the gap between paper and physical can widen without consequence. The moment confidence fades, the system doesn't correct. It reveals itself. Here's the unsettling insight. No single actor has to break the market. Everyone is acting rationally inside their own constraints. Refineries prioritize what they can process, wholesalers cap risk, mints throttle output, defense contracts take precedence, banks restrict liquidity. Each move makes sense locally. Together they produce fragility. This is why mainstream coverage misses it. They look for villains or headlines. But the real driver is leverage layered on top of scarcity, all held together by trust. And trust is not binary. It erodes gradually, first in behavior, then in access, finally in belief. Once belief goes, systems don't collapse all at once. They hollow out. They keep operating, but only for those closest to the source. And that's when the future starts arriving faster than expected. From here, the trajectory splits, and neither path is comfortable. One possibility is managed pressure. Paper prices continue to move, sometimes violently, but physical supply stays tight. Premiums become permanent, availability becomes sporadic. The market doesn't break in a dramatic way. It just becomes harder to access unless you already have relationships, inventory, or leverage to the outside world. Everything looks functional. Underneath, participation narrows. The other path is faster and messier. A delivery failure, a geopolitical escalation, or a sudden loss of confidence forces the paper market to confront the physical one. When that happens, price doesn't adjust smoothly, it gaps. Liquidity vanishes, trading pauses, and the question stops being, what is silver worth, and becomes, who actually has it? Notice the common thread. In both scenarios, the next move isn't driven by retail demand. It's driven by institutions reacting to each other under stress. And that's the danger. Once momentum takes over, decisions get made quickly behind closed doors before the public understands what changed. The next phase won't announce itself. It will show up as a scramble. And that brings us to the final insight. Here's the takeaway most people miss. This story isn't really about silver. It's about what happens when a system built on symbols runs into physical limits. Prices, contracts, balances, and screens work until they don't. And when they stop working, reality doesn't negotiate. It asserts itself. The split you're seeing now between paper and physical isn't an anomaly. It's a preview, a signal that scarcity, priority, and access are starting to matter more than quoted values. When that shift happens, the advantage goes to those who understood it early, not those who reacted fastest. The uncomfortable truth is this: markets don't warn you at the moment of failure. They warn you in advance through distortions that are easy to dismiss and hard to reverse. Silver just happens to be where the signal is clearest right now. The question isn't whether the system resets, it's whether you recognize the signs before the rules change again. If you want to keep following where this goes next and what breaks after this layer, stay close. This story isn't finished.